On New Year's Eve 1999, the world waited for midnight like it was a cosmic coin toss. Bankers feared computers might panic harder than traders on Black Monday. Inside banks, engineers stared at glowing monitors like doctors in an ICU. If clocks flipped wrong, trillions in assets could age 100 years overnight. The fear was simple and terrifying. Computers read years as 2 digits. When 99 became 00, some systems might think it was 1900 again. That tiny shortcut, written decades earlier, now threatened global finance. Turns out, saving memory in 1965 was not future-proof planning. Interest payments, bond maturities, ATM withdrawals all relied on dates. If systems miscalculated, Wall Street could wake up in financial amnesia. The problem had a name, Y2K, the Millennium bug. And it sounded less like doom and more like a bad sci-fi sequel. One of the earliest alarms came from Peter Dieger. In 1993, he warned that governments were dangerously behind schedule. Software expert Ed Jordan amplified the warning. He predicted potential breakdowns across banking and infrastructure. Banks ran on legacy code written in COBOL decades earlier. Millions of lines of aging code were quietly holding the economy together. Fixing it meant auditing every date calculation in existence. That's like checking every grain of sand on Wall Street's beach. By 1998, governments declared Y2K a national priority. The White House treated it less like a bug and more like an invasion. President Bill Clinton urged calm but preparation. He reminded Americans that panic is rarely a good investment strategy. To coordinate the response, the White House created a special council. It was called the President's Council on Year 2000 Conversion. Leading that effort was John Koskinen, often called the Y2K Czar. He coordinated agencies like a general preparing for digital war. Across town, the Federal Reserve ran its own simulations. Because if banks froze, the economy would too. Fed Chairman Alan Greenspan prepared for worst-case scenarios. He believed liquidity was the antidote to panic. The Fed quietly stockpiled over $200 billion in extra cash, just in case Americans decided mattresses were safer than banks. Banks upgraded systems, replaced hardware, and tested relentlessly. It was the largest peacetime IT mobilization in history. International Monetary Fund monitored global readiness closely. Developing nations worried their systems lagged behind. Major banks like JP Chase ran nonstop simulations. If interest miscalculated, bond markets could spiral fast. At Citigroup and Bank of America, war rooms operated 24 hours. Programmers practically lived on coffee and pizza. Technology giants joined the rescue effort. IBM and Oracle saw both danger and opportunity. IBM's CEO, Lou Gerstner, oversaw massive remediation contracts. Fixing old code suddenly became very profitable. Oracle's outspoken co-founder Larry Ellison downplayed the panic. He argued modern databases were less vulnerable than feared. Meanwhile, the media amplified every warning and rumor. Cable news treated midnight like a financial apocalypse trailer. Talk radio predicted planes falling and banks freezing. It was the only time accountants sounded like action heroes. Consumers responded by withdrawing more cash than usual. ATM lines grew longer as December approached. Gold sales spiked as some investors sought safety. After all, gold never worries about software updates. Stock exchanges prepared backup power and contingency plans. Markets even shortened trading hours before New Year's Eve. By late December, the world held its breath collectively. All that remained was to see what midnight would bring. By 1999, estimates suggested the world had spent up to $300 billion. It was the most expensive insurance policy ever written in peacetime. The U.S. financial sector alone poured tens of billions into fixes. Banks treated the bug like it was plotting revenge. The Federal Reserve ran full-scale contingency simulations. They tested everything from payment systems to emergency liquidity windows. The New York Stock Exchange rehearsed backup procedures repeatedly. Even Wall Street practiced for a digital blackout. Clearinghouses tested settlement systems over and over, because if trades failed to settle, panic could snowball quickly. Banks coordinated with global partners to synchronize testing dates. Time zones suddenly mattered more than ever before. Developing nations faced higher risks due to older systems. The IMF tracked readiness like a teacher grading homework. Meanwhile, programmers worked overtime across America. Some joked they'd ring in 2000 with pizza and server racks. ATMs were tested relentlessly for rollover errors. No one wanted cash machines believing it was 1900 again. Bond markets worried about maturity dates miscalculating. A century error could distort trillions in securities. Derivatives desks modeled worst-case failure chains. One glitch could cascade faster than rumor on Wall Street. Some critics argued the fear was exaggerated. Tech executives insisted newer systems were Y2K compliant already. Still, caution dominated financial leadership circles. No banker wanted to explain a meltdown caused by optimism. Insurance companies recalculated exposure risks carefully. They feared claims from outages across industries. Retail investors grew nervous as headlines intensified. Talk radio fueled speculation like dry wood near a campfire. Cash withdrawals increased noticeably by mid-December. Banks reassured customers' deposits were safe and insured. Gold coin dealers reported rising demand nationwide. Some investors trusted metal more than microchips. Yet financial markets remained surprisingly steady. Investors seemed cautiously optimistic despite dramatic headlines. Wall Street prepared emergency generators and backup sites. Redundancy became the word of the year. Trading hours were shortened on December 31, 1999. Markets preferred caution over bravado. Global markets coordinated rollover timing carefully. Sydney would flip first, then Tokyo, then London. The strategy was simple: observe each time zone closely. If something failed, others could respond immediately. As December 31st approached, tension thickened worldwide. Even seasoned bankers felt a flicker of doubt. Midnight in Sydney would be the first real test. The world watched Australia like a financial weather report. If Sydney's banks survived, confidence would rise globally. If not, panic could race westward hour by hour. Engineers double-checked backup tapes and generators. They prepared for glitches like firefighters awaiting sparks. Wall Street waited quietly as the clock neared midnight abroad. For once, silence replaced the usual trading roar. Confidence battled fear in boardrooms everywhere. The final rehearsal was over. The curtain was rising. Sydney crossed into January 1, 2000 without disaster. Financial systems remained steady and functional. Relief spread cautiously as Tokyo followed safely. The digital apocalypse appeared to be running late. As midnight approached Europe, London held its breath. Traders watched screens like hawks, waiting for a digital sneeze. London crossed into 2000 without chaos or catastrophe. Attention now turned west toward New York. Wall Street would be the ultimate stress test. Inside the Federal Reserve, teams monitored liquidity minute by minute. Extra cash stood ready like financial fire extinguishers. Chairman Alan Greenspan trusted preparation over prayer. He believed panic, not bugs, posed the real danger. Banks activated command centers across the country. Engineers waited for midnight with caffeine-fueled focus. In Times Square, crowds counted down joyfully. Few realized global finance was counting too. At exactly midnight, New York entered the year 2000. Nothing exploded, froze, or vanished. Bank systems processed transactions normally. ATMs dispensed cash without confusion or rebellion. Minor glitches appeared, mostly outside finance. Some printers failed, proving paperwork still had opinions. Markets reopened smoothly the following trading day. Investors returned with cautious optimism. The feared financial meltdown never materialized. Instead, relief swept through global markets. Critics quickly asked if Y2K had been overhyped. After all, nothing dramatic happened. Supporters argued preparation prevented disaster. Fixing millions of lines of code takes credit. Economists later called Y2K a prevention paradox. Success looked like nothing happening at all. The spending boom boosted the late 1990s tech economy. System upgrades improved efficiency across industries. Cybersecurity awareness quietly took root. Financial institutions learned prevention beats cleanup. Global coordination became a lasting legacy. Central banks proved cooperation could stop panic. Those lessons resurfaced after September 11, 2001. Markets reopened thanks to crisis playbooks refined during Y2K. They returned again during the 2008 financial crisis. Liquidity, confidence, and speed mattered most. Y2K reshaped how finance approached technology risk. Invisible threats now received visible funding. For programmers, Y2K became legendary war stories. They saved the world quietly, without capes. The public slowly forgot the fear. Life moved on, as it usually does. History remembered Y2K not for disaster, but for discipline, coordination, and restraint. The crisis that didn't happen still mattered deeply, because prevention is finance's quiet superpower. Y2K proved fear can motivate preparation, and preparation can make fear unnecessary. It was the most expensive non-event in history, and perhaps one of the smartest. When midnight came, the systems held. Sometimes success means nothing happens at all. Y2K ended without headlines of ruin, but it left behind a safer financial world. The Millennium bug never bit Wall Street, because the world chose preparation over panic.